UnitedHealth has finally reported earnings. The stock is down 5% on the day. There's a lot of things that I have to talk about. Some good things about the report, some things that have personally surprised me that I'm gonna mention, and it's a little bit tough, guys, but I'm gonna talk about them, let you know my opinion, and let you know everything in general. If I did buy the dip today on UnitedHealth, I've been clear with you guys that I bought the stock at 420. It's down like 37% for my portfolio. I'm still up 31%, but I haven't bought the dip. So I'm gonna let you know what I did today and let you know everything. And I really hope you enjoy it as always. Now, the company missed on earnings per share, massive miss. They got $4.08 versus $4.48 expected. They did beat on revenues, but they did get a massive miss on earnings per share. The medical loss ratio, which is very important amongst the insurance companies, was 89.4% from 85.1% from the prior year. So it was really terrible. And this is of course because of healthcare expenses during the quarter. They were much faster than the premiums. And this is the only, not the only reason, but this is the main reason why United Health is struggling, is because the expenses are much higher than what they charged for the premium. So what is the solution for that? They have to raise the premium for them to match up for the increase in expenses. It's as simple as that. You have something that costs $2, you're selling it for $1.50, you're gonna have to raise that $1.50 a little bit. And it's not just United Health, it's all the insurance companies. So it's not like people will leave United Health and then join some other kind of company, because all of them are in the same boat, and all of them are gonna have to, unfortunately, raise premiums for them to break even on a lot of the costs that they're facing. And they said it themselves. They said the primary driver of the United Healthcare's earnings shortfall for 2025 is that our pricing assumptions were well short of our actual medical cost. Our current view for 2025 reflects $6.5 billion more in medical costs than we anticipated in our initial outlook. We're not talking about a million or five or a few hundred million or even $1 billion. $6.5 billion more than their cost for whatever they got for those premium. So they're gonna have to raise prices. It's unfortunate, but that's what United Health is gonna have to do, and that's what a lot of those companies will have to do. And if you look at the word pricing, they mentioned pricing 26 times in their conference call, and this is the main ways they're gonna be able to fix this. And they said, turning now to 2026, our pricing strategy is intensely focused on margin recovery and moving back towards our earnings growth target. But it's not just about them raising prices. They're gonna have to, unfortunately, exit some markets where they cannot do too much with prices. And many insurance companies exited a lot of markets where the numbers didn't make any sense. And United Health went in those markets trying to take market share, but now they're figuring out why all those companies like Aetna and others left those areas, because the numbers don't make any sense. So now United Health is leaving also. And they said, we have made a difficult decision to exit plans that currently serve over 600,000 members. So that's going to affect revenues a little bit going into 2026. But now the company is more focused on profitable growth and they're focused on margins. They took a look at those 600,000 members. They just can't see any ways they can match up for the increasing costs. So they're going to have to exit those 600,000 plans. It's unfortunate, but maybe other companies will take them. And that's what United Health is having to do. So it's a mix of pricing, it's a mix of them exiting unprofitable markets for the company, and it's also a mix of how long someone has been in their own ecosystem, which is something that I didn't know, is that the longer someone stays or remains within their current plan, the more profitable it becomes for the insurance company. And it's something that I didn't know, but they said it themselves. They said margins improve the longer patients remain. Our most mature value-based care cohorts, those from 2021 and prior, are operating in an estimated 8+% margin in 2025. Those in 2022 and 2023 cohort are operating at a 2% margin. The 2024 through 2025 groups are at negative margin. And this is, they explained, because when they stay longer in the plans, they go through their annual doctor checkups and they do all the checkups, all the important things to keep up with their health. So that means they're going to have to do less and less of the expensive stuff, which is very costly for a company like UnitedHealth. And it's also better for the patient. So the longer those patients remain in the company's healthcare system, the better it is for the patient, but also the more profitable it becomes for UnitedHealth. So it's a mix of pricing, it's a mix of exiting markets, and it's a mix of how long those cohorts have been in the UnitedHealth ecosystem, which is something that I didn't know. And to me, it's very, very interesting. Now, I still have the antitrust investigation, which I talked about before, and it's not the first time the company faces an investigation. And they said we have stepped up our audit, clinical policy, and payments integrity tools to protect customers and patients from unnecessary costs, and they're working on it. But last time, they also had a DOJ investigation, and UNH actually won the settlement. They were not guilty of whatever they accuse them to, and that happened multiple times. And maybe this is another time where UNH isn't guilty, or maybe they are. We don't know yet, but we cannot determine that before we know the final judgment. Now, in terms of growth, and this is the part that was a little bit disappointing, they mentioned 2027 a lot in their conference call. So if you listen to the conference call, they say 2026, yeah, but 2027 is going to be much, much better. Before that, they were saying this year is going to be challenging, but 2026 will be better. Now they're saying 2026 will be slightly better, but 2027 is the year. So to me, it's looking more like the recovery is not going to happen before 2027, which is something that I did not expect. But this is what they said. They said, looking to 2026 at this distance, I would expect solid but moderate earnings growth. Of course, they're going to have earnings growth because this year they pretty much trashed guidance. I mean, the guidance was so bad and they pretty much had little growth in earnings. So on a comp basis, they have to grow in 2026. It's just the law of numbers. But I said, as we look further ahead, we see our earnings growth outlook strengthening quickly in 2027 and pacing steadily upwards over the succeeding year. So again, they're mentioning 2027 a lot as the main recovery year. And this is not something that I planned to. I thought UNH will play out in 2026. It looks like it's going to play out in 2027. And that changes a lot of things for me, which I'm going to talk about later on. Now, in terms of guidance for 2025, they put up an outlook of $14.65. Now, $14.65, that would put the company around 16 and a half times earnings. So UNH right now is trading at 16 and a half times earnings. It's not trading at 13 forward PE, which what we looked at before. And I told you guys the final PE ratio will likely be higher as the company will kitchen sink guidance. And they did. And if we're paying, so now we're paying around 16 and a half times earnings for pretty much the worst case scenario in terms of guidance. And it's going to be much easier for them to beat on those guidance number. So worst case scenario, we're paying right now 16 and a half times earnings with an average of around 19 times. To me, this is really not bad at all. It's not a bargain at 16 times earnings. Not as good as 13, I'm just being honest. But this is depressed earnings. So if we're looking just at 2025, that's like the worst case scenario ever. But if we're looking at 2026, 2027, it's not going to be 16. It would most likely be 13, 12, even 10. If we go to 2027 and we put in 10, 12, 15% earnings per share growth, which is what the company is planning to grow. And I did ask them about the potential growth over the long term, because the company had 13 to 15% of long-term earnings per share growth. So they asked the CEO about this, and they asked him, is it still your guidance? And he said, I expect we will pace back steadily to low double-digit range and continue to advance from there. And I think, importantly, the framework for our long-term growth outlook remains very much intact. So they're still expecting 12, 13, 14% of long-term earnings per share growth, but that's unlikely to happen before 2027. But he said something very important. He said the compounding effect of capital applied in the form of share buybacks as we return value and capital to shareholders. So we're trying to get an insight of how they're thinking, and they're looking at buybacks as an amazing way at this price to return a lot of value to shareholders. So don't be surprised if on the next earnings report, they announce some kind of a huge buyback program. They don't have to buy it all at once. It could be a 4 years buyback program, but it looks like a huge number and the stocks bottoms out on a big buyback program. Happened to many stocks I've seen. It's one common way. A lot of those cheap stocks bottom on a massive buyback announcement could come as soon as next quarter. I wouldn't personally be surprised at all. But now we have a situation where the company has pretty much kitchen sink guidance. They set very low expectations. It's unlikely to get worse from here. It's unlikely for those numbers to be even lower than they already are. And based on those numbers, we're paying around 16 times earnings, which is lower than the average of 19 times for long-term earnings per share growth of around 12 to 13%. To me, this is really not bad at all, taking into consideration that this is the worst case scenario, 16 times for 12-13%, it's not bad at all. But the only thing for me is I was not expecting 2027 to supposedly be the recovery year. I was thinking it would be 2026. It will likely be 2027, which is why I'm personally taking my time a little bit more in terms of buying the dip on UNH. So if I was still expecting, let's say, 2026 to be the recovery year, I would say, okay, I'm going to buy the stock right now. But because that's unlikely to be the case, maybe I'm going to buy the dip a little bit later. But I'm not in rush to go all in UnitedHealth and then just go crazy on the stock, because it's gonna take much longer than we expect it to play out. Maybe the market is forward looking and the stock goes to 600 before 2027, but I would not expect the stock to play out before mid 2026, the way I'm looking at it and the way I've seen other setups, which is why for me I'm taking my time a little bit more in terms of buying the dips and doing other things on the stock. So I'm just waiting, but to me it wasn't too bad. I was expecting worse. It's not as bad as expected. 16 times earnings for the worst case scenario, as long as the DOJ stuff isn't too bad in terms of a lawsuit and they announce a buyback program. That's all we need on UnitedHealth. And it looks like, it's getting closer to the end than the beginning of the bad news. And a lot of good things should come after this. So I like what I'm saying. Not bad at all. And that's just my opinion on UnitedHealth. Hope you enjoyed it. Thank you for watching. Now, financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.